Hi, I'm Keith Bowes, Managing Director for Lotus Resources. Lotus Resources is an Australian company. It's listed on the ASX and has two assets over in Africa. Our primary asset is the Kayelekera Uranium Project, which is located in Malawi. It's a past producing asset, operated between 2009 and 2014, and shut down because of economic reasons. The company at the moment is very much focused on bringing this project back online as soon as possible. We have a DFS out there currently working on a FEED program, and both of those pieces of work have indicated not only a fast restart for this project, we're talking circa 15 months to bring this mine back into production again, but also very low upfront capital of around $88 million. Our second project is a greenfield project, which is located in Botswana called Lani. This is a project that we acquired through a merger with another Australian company called ACAP Energy, which we completed in November last year. Lani is a large-scale uranium project with significant resources associated with it that we see as being the long-term generator for the company going forward.
Keith, good to see you again. Exciting times out there. You wouldn't know it from the markets, but exciting times out there when it comes to uranium and the conversations around who is going to be able to get into production anytime soon. You got a couple of projects. Obviously, we've got Malawi and Botswana. Can we just get an update on each of those projects so we can sort of understand the landscape for you first, and then we talk about how you fit into it? Kayelekera, you talk about getting into production 2025. Still on track?
Still on track for the end of 2025, yes.
Okay. So I couldn't help notice the sort of the image on the front of your PowerPoint. It suggests that, that there's a lot going on the ground. What's left to do?
So really, when we're talking about Kayelekera and the restart, there's 4, maybe 5 major work streams that we're focused on at the moment. The most intensive one is really our front-end engineering and design program. So as I mentioned, we have a feasibility study out for this project, but that was announced to the market in August of 2022. We do recognize there's been some changes in terms of costs of various things. So we're doing this FEED program to generate a new updated capital cost for this project. At the same time, we're going to be refreshing the operating cost estimate for the project and also refining the execution schedule. So our feasibility study showed about 15 months for us to be able to refurbish this plant and bring it back online again. And that was very much dictated by a number of long lead items. So through our FEED program, we're investigating that in more detail, understanding what the impact of those are on the schedule, but also understanding what the scope of work is required for the general refurbishment on the plant. That's a big focus we have at the moment.
Right. Can I try and just try and understand and break that down a little bit? Because like time is money, we get that. But money is money too. Do you still expect, legacy issues around costs, driving up? Because we've seen a few other kind of metals companies, have their balance sheet blown out of the water. How much do you think things are going to change, or is this really about just nailing down the process of building what you need to build?
I think in general it is related to nailing down the process, but as we said, we are going to be updating our capital. And I know when I look at other projects that have recently updated their capital costs, and there have been a number out there that also delivered, say, feasibility studies in that 2022 period and have very recently updated their capital cost estimates. And they seem to indicate that capital costs have gone up by about 5 to 10%, maybe 12% in some of those circumstances. But when I have a look at our project, I think one of the important things to recognize is that because we're a brownfield project and a lot of the costs associated with our restart are not actually the purchase of equipment, but are more like cost reimbursables for labor to redo civils or to do concrete work or to do some structural steel work and all that. I'm not expecting our capital costs to be at the upper end of that increase. In fact, I'm expecting it to be at the lower end. So we would expect to see some increase, but I think it's going to be pretty minimal, especially when you compare it to some of the other projects out there.
Right, and then the phrase of long lead items, those are stuff that you've got to purchase globally and then import into country. You're saying that a lot of the stuff that you're going to be spending money on can effectively like civil works.
That's where the majority of our refurbishment costs have been spent, although we are buying some new equipment. And I think we've spoken about this before. We want to connect the plant to the national grid. So that requires us to construct a 50-kilometer transmission line. That in itself is not a long lead item, but I think what is the upgrade to the substations. So we talk about switchgear, we talk about capacitors, we talk about transformers. Those are the types of things that we are going to be identifying that will form part of that long lead list. There are other things that are within the plant itself. So I think we spoke about a new acid plant that we've decided to install. Again, that would sit on that critical path as well. And probably the ore sorting unit as well as a piece of equipment would also sit there. But I think what's important to note, Matthew, is that we did a raise back at the end of Feb for 30 million Australian dollars. And really the intention behind that raise was to give us enough money in the bank such that we could commit to these long lead items without it impacting on the schedule. So as soon as we understand what these long lead items are, we're cashed up enough to be able to place the order for those long lead items to ensure that we can still meet this 15-month timeline that we've spoken about previously.
So, like, there's a lot going on. You're busy on the ground, and certainly images would suggest that there's a lot already there. We've seen elsewhere, we've seen in Indonesia, the government saying, well, actually, in the case of one company, you're not moving quickly enough. We're taking this back off of you. That's caused them problem. What you've been able to do with this kind of restart in country is, make sure that you're delivering to expectations. There haven't been delays. Is there anything else that you feel that you need to be kind of focused on in terms of that kind of social license element, whether it be locally or federally?
I think from a social license to operate perspective, it was one of the things that we picked up on very early when we acquired the project was to build up this trust with the local communities. We've certainly done that. We make sure that for example, through our corporate and social responsibility budget, we support the local schools, we pay for teachers, we support a number of students who don't have enough money to be able to go to high school. We pay for the high school fees. We support the clinic. We do certain activities around fixing up roads. Any problems with any of water supplies, we'll go in there and fix those types of things up. So the communities know that we're in there doing things for them. We also know at the same time that as part of the new Malawian Mining Act that came in 2019, there's a requirement for us to form to have what we call a community development agreement. And this is a new thing in Malawi. We'll be the first company, I think, to actually go down this route and to implement this program. But what that requires is that 0.45% of the gross revenues generated from the mine are put into a separate account, which the communities can then use indirectly for the projects that they want. So there'll be an organizing committee set up with the various qualified communities. Each of the communities within that area will then be able to put forward their suggestions or their want list, let's say, for what projects they would like, whether that be new schools, new boreholes, upgrades to whatever. And then the committee makes a decision, based on that list of requirements of which projects will be supported that year, which will then be funded by the 0.45% coming out of the gross revenue. So we've done a lot of engagement with the communities around that. We have a CDA, a Community Development Agreement, in draft form that has been accepted by the communities and will be then signed off by the government to allow us to do that. So the communities can see that coming as well, and that also gives them, real comfort that Lotus and Kayelekera as a project is there to support the communities. We've also worked with the Paramount Chief very, very closely. So the Paramount Chief is the ultimate, let's say, rural person in the site. In fact, he's considered to almost be the king of northern Malawi. We have a really good relationship with him. He's very supportive of the restart. So from a community perspective, we've got nothing but goodwill coming in from the community for the restart of this project.
Good. And like decentralization of government, I wish we'd implement that here in the UK. And with regards to the sort of expectation around jobs and other kind of indirect pardon me, coughing away. Indirect contribution to the area. What does this mean for people? And what could it mean for the locale?
I think this is one of the unique situations in that we find ourselves, is that Malawi itself is a very poor country, and northern Malawi is probably poorer than the rest of the country. So prior to the start of Kayelekera in 2009, you've got these very poor communities in the area looking for jobs, basically on subsistence living. Kayelekera starts up. There's certainly a very large demand for local employment coming through either directly at the mine through a series of unskilled or semi-skilled positions, and in some cases some skilled positions as well, but also the roll-on effect of indirect jobs. And we know from projects we've done in Africa previously, for every job that we have on the mine site, it probably encourages another 5 jobs outside of the mine area as well. So when we talk about 450 jobs at the mine site, we're probably talking about, an extra 2,500 jobs being created at the mine site. So this is what happened in 2009, and there was a huge uplift in terms of the local economy through this employment, through jobs, through services, through businesses that were starting up. And Karonga, which is the nearest town to the mine site, became a very thriving area. There was a lot of business going on there. As I said, the economy grew significantly during the period that the mine was operating, and everybody was happy with that. The mine shuts down in 2014, and everything just crashes on the back of that. Jobs disappear, businesses have to go under, services are no longer required, and all that kind of stuff. So the local community has seen the impact of mining, both on the positive side in terms of driving up the opportunities, but also understanding what happens when that mine, stops working or stops. Then you see this drop off in terms of the economy. So everyone remembers this, and everyone's looking that when this mine restarts, we're going to be back to the good old days. More jobs, more services, more businesses operating, and all that kind of stuff. So we are in that position where that the local people can actually reference their own history to understand what the impact is of a mine in the area.
Right, and the reason I sort of asked this is because obviously you got the mine development agreement conversations to be concluded on that.
To be concluded.
I'm trying to work out, are there any barriers to that happening?
Not at the moment, no. We are certainly well advanced in those discussions. And I think we've spoken about this on a number of occasions, Matt, in terms of, Africa is a little bit slow at times, unfortunately. We need to be there, face to face, talking to the various ministers or to their delegates about the mine development agreement. But certainly one of the things that has happened fairly recently is that Malawi had its first mining summit, which they held in February or March of this year, where a lot of the international mining companies that have got projects in Africa attended. And we were very fortunate in that the president stopped by to have a conversation with us at our kiosk. And we were able to talk to him about the project. He asked a number of questions about, what can Malawi do to support the project and all that kind of stuff. And really on the back of those conversations, and I'm assuming conversations with other people at the summit as well, he's actually asked his presidential delivery unit group, which is a group that he brings in where he sees there's maybe some bottlenecks in processes or something like that, to be engaged in the mine development agreement and the establishment of the mining industry. And that's happened in the last couple of months. And we've certainly seen some significant progress in, say, speed of decision-making and all those types of things being impacted by this PDU unit starting to engage with the various groups as well.
Again, it's referencing back what's happened up in Niger recently. I think the fact that the company in question was not able to access capital, was not able to advance their project, has caused I think people refer to this, the junta, the new government up there, to say, well, actually, you're not moving quickly enough. You're not going to create the jobs. You're not going to create the taxes. You're not going to kind of create that kind of ecosystem around the business. We're having that back. In this instance, is the Malawian government? I get the positive talk and hopes and aspirations, but do they also need to see you get the kind of financing in place before the mine development agreement can be put in place? Because it seems like a catch-22 there potentially. And if so, is that going to mean that you need to advance conversations around the uranium offtakes, for instance? So how does all that work? Because it seems all very interlinked.
Correct. It is interlinked, but it's actually it's the other way around, in that we need the mine development agreement to be able to complete the financing and also to be able to complete the offtake. And we've been very, very open with the government around that it's absolutely critical that we get this mine development agreement done as soon as possible so that we can finalize these discussions. But of course, we haven't used this as an excuse not to engage. So we've, as I think you'll know, is we've already appointed a debt advisor to help us navigate the debt process, and that's going very well at the moment. We've had lots of conversations with Offtake, around Offtake with utilities, specifically North America, but also European as well. And in fact, the team was in Atlanta in Georgia at the beginning of June at the WNFM conference there. And we had 2 solid days of meetings with North American utilities. There was a lot of interest coming in as to when is Kayelekera going to restart. And actually post those meetings in Atlanta, we've got 4 or 5 conversations that are going on that are progressing very, very well around offtake. So sort of the message to the government is, listen, we're moving as fast as we can on offtake. We're moving as fast as we can on the financing stuff, but we aren't going to be able to sign on the dotted line until we get this MDA in place. But once we've got the MDA in place, we don't see any hurdles to signing off on those final things, which will then allow us to start to mobilize to site, start employing local Malawians, starting to spend money in Malawi for the refurbishment of this project.
Well, listening to you, it kind of feels like it's more real than ever. Obviously, you've been advancing things on the ground, and the fact that we're talking about production issues so you are working towards producing at the end of 2025, right? So that's great. What I noticed was, I think that really kind of made me sort of sit up and listen was this new group of guys that you brought onto the management team in terms of their execution experience. You want to tell us about what that has done for you? Why bring them in now? Could you not have got there without them?
Sure. So, I mean, with the amount of work that's going on at the moment, not only for Kayelekera, but also around the Letlhakane stuff, we made the decision a few months ago we needed to bulk up our management team to be able to execute on this. I mean, prior to that, we had a pretty slim team sitting here in Perth managing things. So what we've gone and done, we've appointed a dedicated, let's call him a project director for Kayelekera, who's running the feed program for us. He'll then move through the execution phase and into the startup of the mine. That's his skill set sitting there. He's a process engineer, has worked at a number of EPCM contractors before. He's been on the operations side as well. He's been on startups and all that kind of stuff. So he brings a wealth of experience in terms of being able to move through this phase of the project development. At the same time, for our Letlhakane project, which we recognize obviously at a much earlier stage, but really what we want to do around Letlhakane is we believe there's a lot of optimization potential there. So we brought in a study manager who's also a process engineer and a metallurgist. He's got, again, lots of experience in uranium. Worked for BHP Billiton at Olympic Dam, was a uranium metallurgist there. Has been involved either directly as working for some companies like Toro, which is another uranium company, or working for EPCM companies when they do projects, other uranium projects. So he's got a lot of uranium experience out there, and it's his focus in terms of getting Letlhakane optimized so we can develop an optimized program. So we brought those 2 guys on, and then also to support them, we brought on Mike DaCosta as our Chief Operating Officer. Mike DaCosta has lots and lots of African experience. He's a mining engineer, worked for Anglo American and did a lot of project startups there, operational experience, and also we recently worked for Murray & Roberts, where he was the Chief Operating Officer there for their mining section. So he's got a lot of operating experience, which will help us through our operational readiness stuff. How are we going to get Kayelekera and corporate, I suppose, to change over from being this explorer developer to being an operator producer? Because there's a lot of head office work, a lot of corporate activity that needs to be done in terms of changing the focus of the company as we go through that. And Mike's going to be able to help us out a lot on that. And then also to support us going forward, we've brought on Greg Batar as well. So Greg Batar's investor relations, but also corporate activity as well. So he's been helping out in terms of the offtake discussions, also be assisting on the financing stuff, and is also building in terms of our IR investment, range as well for when we go out and complete our financing strategy and all that stuff. So really brought us some key guys that are supporting us as we move forward.
That's exactly the question I actually wanted to get to at the end here, which was Greg's role in terms of business development, like the IR bit, of course, but the business development bit in in relation to the offtake conversation. Now, I suspect as one of the very few, possibly handful of people talking about the game of getting into production in the next 18 months, maybe a lot of inbound, but there's also the need for you to get out there and tell the story as well. So in terms of how much focus is going to be given to that over the next few months, can you sort of tell us how you go about doing that, how you go about putting yourself in a position to get the best possible offtake agreements in place if you're ready to?
Yeah, so I think, in terms of my focus, obviously, as you know, I've got a technical background. I'm a chemical engineer, so obviously projects and all that kind of stuff have always been my mainstay. But I think that by bringing on Mike DaCosta and bringing on Stuart as the project director for Kayelekera and John on at Lani, it gives me the opportunity to free up some of my time to focus on those things. So myself and Greg, as you said, at the IRL, but also our CFO, Mike Ball, as well, are very much focused now on these offtake agreements, on the financing side of it, and that's where we're putting a lot of effort in there. Investor relations also really important. We want to keep our investors updated with what we're going, but also as we go through the process, we've got recently moved up to the ASX 300. Being an ASX 300 company, there's a lot more activity required around investor relations, around governance types of things as well, and that's what we're also busy working on. So bringing on the people, not only you've got the right people in the right places, but it's freed me up to focus on some of the other things that are required to be done before we can actually start this mine back up again.
So just very specifically, how do these offtake conversations advance? What do utilities need to see from you? I guess the slightly more robust management team is very, very comforting. And, you updating them on how things are happening on the ground in terms of, working towards this 2025 delivery schedule, but what else will they want to see from you? Because those, as my understanding is that those sort of agreements tend to sort of start small and build up as you deliver it into contracts. So how do you prove that you are worthy of having a discussion with?
So I think, when you're talking to a utility, top of the pile for them at the moment is security of supply. They want to be confident, and they're going to sign an agreement with you. You're going to be able to deliver on that. There's no doubt about that whatsoever. Pricing is almost secondary now compared to that. And I think the conversations that we've had with the utilities, we have been talking to them for a while now. We haven't just started this in the last month or two. We've been talking to them for 18 months or something like that, keeping them updated as to the progress at Kayelekera, in terms of the boxes that we've ticked, in terms of the development, the start of the feed program, the updates on the feed program, and those types of things. So they can see that we are moving forward in terms of the development, and we're doing what we say and say what we're doing as well through the process. We give them an update from the government perspective as well in terms of the support we're seeing from the government for the restart of the process. So they're certainly seeing that coming in. Obviously, the first couple of agreements that we're going to be signing with utilities are probably not going to be huge in terms of the pounds per annum. We're not looking for that anyway. We want to be able to enter into the market, to be able to demonstrate to our shareholders, to be able to demonstrate to our investors that the Lotus team is capable and has the skill set and the experience to be able to enter into these contracts. I think that's the first box that we want to tick. From the utilities perspective, and we can talk about this when we get into the marketing section a little bit later, but, a North American utility, from my understanding, prior to maybe 12 months ago or something like that, they were looking for uranium. Well, they'd go to Cameco or they'd go to Kazatomprom, and they'd sign a contract with them and there'll be certainty of supply around that. However, Cameco and Kazatomprom have forward sold all of their production for the next, 4 to 5 years. There's no material available from Cameco or Kazatomprom for a North American utility to sign up. They need to go down to the next layer of producers to be able to secure that supply. And things that they're offering to us in terms of ensuring that we will be able to deliver on the timeline that they want is not only have they accepted the higher prices that are out there at the moment, but they're talking about prepayments as well. If we gave you a prepayment, would that help you get started up? Those are the types of conversations we're having at the moment with a number of these utilities. So they're very, very invested in terms of getting this next tier of projects up and running so that they can actually secure the supply that they need moving forward.
Okay, interesting. Look, I said, there's a good conversation around, you being, I guess, positioned and seen as one of the next producers of that. Very few people talking that game at the moment, for sure. So I think that's quite good, but it's of a certain size, and I think you did something about that, obviously, when you went and picked up Letlhakane as well. But I would also say, I think at the time that you did it, it kind of felt, well, that's a smart move. It sort of suggests a desire to kind of de-risk from the single asset model, also, single jurisdiction model, essentially. But in itself, it didn't look like a great project. It looks sort of okay. So what have you seen, or what are you doing to try and maybe unleash the potential of the project down in Botswana?
Sure. So, I mean, you're right there. If you look at face value on what was presented, and I mean, the report to be looking at would be the 2015 feasibility study that was generated by ACAP. You have a look at that. It looks like an okay project, but nothing that's earth-shattering, let's say. But I mean, we know from our own skill sets, and we've been through this on a number of projects. I mean, Honeymoon is a project that we were involved in the early days, and it was our group that redefined how to operate the well fields, how it was with regard to, converting from the solvent extraction circuit to ion exchange. We've done exactly the same thing at Kayelekera. We took Kayelekera, which was a relatively expensive operating asset, into something where I think at $29 per pound, we sit comfortably in that second quartile. And with uranium prices where they are at the moment, and understanding where we're going to be signing contracts at, Kayelekera is going to be a significant cash generator moving forward. We can bring those skill sets to Letlhakane. And we picked up on very early, when we were doing our due diligence on that project, that there were a number of things that we had done at Kayelekera that we think are applicable to the Letlhakane project. We also recognize that maybe the approach that the previous owners had taken, probably in the current environment, is not the best way to develop that project. We're obviously much more focused on what we would call economic pounds or recoverable pounds, which is one of the things why we've redone that resource estimate and come up with a new mineral resource estimate that is pit constrained, because that's the way we look at things. But what does increasing the grade mean for the project? It has a huge impact, not only in the production profile, but we also know, for example, that metallurgical recoveries are increased when you increase your grade, and we've got the evidence to support that. What does that mean? Well, it means less tons being moved. It means smaller processing facilities to be able to handle the smaller tons. All of these have an impact with regard to capital costs, but also with the way that we're approaching things like acid, or we're looking at things like ion exchange instead of the solvent extraction circuit that they had there. Those are all drivers to operating cost as well. How can we make the best use of the acid that we're adding to that circuit and bringing all of those things into it, which is exactly the same we did at Kayelekera, and we can see us having a similar impact at Letlhakane. Letlhakane is a much bigger project than Kayelekera. I mean, we could see Letlhakane having a 20-year life of mine, producing, 3 million, 4 million pounds per annum or something like that for that period of time. Now, this is a big project out there, especially when you compare it to some of the other projects. And a good example that I like to use in Paladin's Langer Heinrich project is a fantastic project out there. It produces 6.9 million pounds for the first 7 years or so. But over its 17-year life of mine, it produces 77 million pounds of uranium. We think Letlhakane can be a similar scale. We think it can be producing that 75 to 80 million pounds over a 20-year life of mine. I mean, that's the sort of scale we're talking about for Letlhakane, and that's why we liked it so much.
Okay, no, I can see the attractiveness of that, but you've got a fair bit of work to do between now and then. And the other thing you've got to do is kind of get that balance between how allocation of capital and resource, and and again timing the market, because you've got to make sure you deliver into that 2025 production schedule with Kayelekera. So how, in terms of what you do over the coming months at Letlhakane, how do you plan and map that out? Because there's expensive stuff like drilling, right? And then there's the whole bunch of other stuff that you're talking about, which kind of affect the kind of future economics. I'm worried about the economics now and getting distracted, and not focus on being a producer.
Sure.
How do you manage that?
As you said, Kayelekera is our primary focus. We want to get Kayelekera up and running by 2025, and that's very much what we're focused on. But by bringing in these additional people like John, and also we inherited the Botswana team from ACAP, when we took over that company, there are certain things that we think are worthwhile spending time and effort on at Letlhakane now. You spoke about drilling. Well, we're doing an infill drill program. At the moment, the resource that we have is 118 million pounds, but about 70% of that is in inferred status. It's difficult for us to be able to put any project economics around something that's got that high level of inferred material in it. We need to commit to the infill drill program to be able to convert that inferred into measured and indicated, so we can then start to do some economic studies around that. So that's what we're busy with at the moment. Fortunately, drilling there is not that expensive because the deposit itself is actually quite shallow. We're drilling down to about 70 meters in some areas and 110 meters in other areas. So it's not very expensive drilling for us, and it's all RC drilling at the moment as well. So we're able to manage our budget effectively without committing too much, dollars to the Letlhakane project. But we recognize there are important things we need to do to be able to develop this project. And really what we're thinking around doing, Matthew, is that we start up Kayelekera, starts up at the end of 2025, starts producing product in 2026. As I mentioned, with the cash costs that we have got and our expectation around the price we're going to receive, we're going to generate some serious money out of Kayelekera, and we will use some of that money for the development of Letlhakane. So we're not looking at, going out and doing massive capital raises for Letlhakane. No, Kayelekera will be able to provide the bulk of the money that is required to be able to develop Letlhakane. There may be some debt opportunities for us through credit agencies or development banks or something like that. But ideally, we see about 3 years worth of technical work ahead of us at Letlhakane. And if we make final investment decision on the completion of that technical work, probably about a 2-year execution period to get Letlhakane up and running. So Letlhakane is up and running 2029, 2030, sort of our time frame at the moment. So we have the two projects overlapping for a period of time.
Okay, just because I think okay, I just wanted to understand that because I think to be able to put some economics on it with this infill program and obviously some kind of economic study off the back of that, I think will do a lot for your market cap, but not as much as getting into production or showing that you're very near term production with contracts in place. And offtake agreements in place. So that balance kind of works. In terms of how you're finding you're working down in Botswana, is quite similar to Malawi in that sense. You dealing with the same sorts of issues, or are there other issues?
No, it's certainly a little bit easier than Malawi, and the reason why I say that is that Botswana has a very rich mining history. I mean, mining started there in the 1970s. Predominantly diamond mining for diamonds, but the mining industry has expanded past diamonds. There's copper mines there. If you look at Sandfire as an example of that, they've previously had nickel mines there. They are looking at developing some of the other commodities out there. So you have a very, very sophisticated and experienced, for example, mines department. The director of mines is a mining engineer, and in fact, even the minister of mines is a mining engineer as well. So when you're talking to these people about project development, maybe around some of the timelines required for things or some of the challenges that you're facing in development, you're talking to people that understand the lingo that you've got, in the mining industry, which just makes those conversations so much easier for us to go through. So we're finding working in Botswana to be a very, very easy jurisdiction for us. Infrastructure in the area is great. We're not seeing any issues with anything like that. So if anything, it's probably a little bit easier than Malawi, just because they're an experienced mining jurisdiction. So like I said, mining's been going on there for over 50 years.
Okay, and just in terms of the market, so I think in terms of the project, I understand where you're at. And just in terms of the market and positioning for yourselves, I think we've referenced a couple of times the fact that you're probably one of a handful of people talking about getting production in the next 18 months, right? You said we'll be throwing off a lot of cash here. Obviously, those two things, I guess, appeal to investors. But in terms of how you position yourself in the market, in terms of your IR activity, in terms of your marketing and conversations, offtake agreements? I mean, what does the kind of current setup, and obviously, I'm going to include the Botswana project in there in terms of this kind of blended production portfolio that you may have through to 2030. How does that help conversations? The fact that there's very few people in your position, people, I guess they're approaching you, but how easy are those conversations? Are the conversations still difficult? I mean, you've still got a lot to prove, right?
I think there's a number of boxes that we still have to tick. And I mean, we touched on some of those earlier. The feed program, I think people want to get an understanding of what the capital is. Has the capital gone up significantly since we did the feasibility study? The mine development agreement discussions that we're having with the government are obviously absolutely critical, that allow us to then complete offtake and complete financing as well. So people are looking at us and they've got some very, very close eyes on us, but they're waiting for us to complete these number of things, I think, from my perspective, before they're fully committed to jumping in with investments or something like that. So that's sort of my feeling at the moment. But I certainly know from the conversations I've had with multiple people, the overall concept of how Lotus has put together the Kayelekera project with the Letlhakane project, how we're looking to get Kayelekera to finance Letlhakane, how having those two projects together means that effectively the company is going to be a uranium producer for the next 20 to 25 years, is a story that is really liked by the shareholders and the investors. And even from a utility perspective, even though the conversations at the moment are around Kayelekera, we're certainly talking about Letlhakane and Letlhakane being a future producer. So although we can't commit to production coming out of Letlhakane, we know if we build up good relationships with these utilities, getting product offtake from Letlhakane into North American utilities should be a relatively simple program, because they're dealing with the same company that they were previously with Kayelekera. So, the story's going down really, really well with everybody. As you said, they do recognize us as being one of the earliest companies to come back into production. We have low capex, we have a short restart time, but we have also, this potential to be this long-term producer out there. And people are, that's what people are looking at.
And then, where do you think the kind of growth potential in the story is for you guys? Because we see a lot of companies talking about the theory of getting into production. We speak to a lot of companies who are predominantly focused on making a exploration, making a discovery, or the hope of making a discovery, to kind of drive that growth story. For you guys, you've had a good run of it for the last 4 years or so. Where's the upside come from? Is it going to come from Letlhakane, or is there more elsewhere?
I think in the short term, it's Kayelekera. I think, as you mentioned a bit earlier on, if we can tick the boxes to say we have an MDA, we've got some offtake in place, financing is sorted out, we've got a comprehensive execution schedule to be able to bring this project back online, I think that's going to go a long way to driving value for the company. But in the medium term, it's probably Letlhakane, I think. I think at the moment, Letlhakane, as you've said as well, that when you look at the historical data associated with that project, people have looked at it and said, yeah, okay, it's an okay project. But I think what we can bring to that project and what we can then show to the investors and the shareholders is how we're going to execute that project with higher grade material, lower, material movements, optimize that processing plant, simplify the processing plant to drive that capital cost number down. Look at the things we've done at Kayelekera around acid recovery and acid utilization. How can we implement that there? What can we do to be able to, improve the economics significantly at Letlhakane, which I think we can, based on the work programs we're doing at the moment. For me, when people understand that, for example, Letlhakane could be the next Langer Heinrich sort of scale project, I think that's when people are going to start to take notice of Letlhakane, and that'll start to drive the value in the company as well.
And just going to finish off, Keith, we're talking. We talked at the beginning, or I referenced certainly at the beginning, the kind of market's perhaps not reacting particularly well in the last 2 weeks, but I think that's probably feels like it's an Aussie end of year tax season, taking tax losses, etc. thing. I mean, how do you interpret it?
I think we're a bit frustrated with it, to say the least. I mean, obviously, when you look out at what is influencing the share price, from a uranium market perspective, there's certainly been nothing other than good news out there. I mean, when you listen to what's happening in the US with regard to their funding, when you talk about all the new projects that have been, or new reactors that are being considered, all the small modular reactors, all the governments, talking positively about net zero and all that. We can't see any negative news out there at the moment. We do recognize that the spot price itself has probably been moving sideways for the last couple of months, or last couple of weeks at least, the sort of that 82 to 88 range, which maybe is causing a little bit of angst with some of the shareholders. But I think what somebody needs to look at, and somebody's looking at investing in a uranium company should be doing, is not really looking at the spot price, but trying to look at the term price. So the term price is something that's a little more opaque than the spot price. It's normally quoted by companies like UXC and TradeTech on a monthly basis. And I think what's really interesting when you look at that term price, the term price started the year at $68 per pound. Today's term price is $79 or $80 per pound, depending on whether you look at UXC or TradeTech. Each and every single month this year, the term price has increased by either $1 or $2 per pound. And again, why is that so important? When you look at the uranium market, only a small percentage of product is actually traded in the spot market. And most of that trading is done between either financial institutions, some traders out there, or some physical funds out there at the moment. The bulk of the uranium offtake or trading is done in the term market, and that's where the utilities sit. That price, as I said, has been increasing considerably and continuously increasing over this year to the level where it is at the moment. And that's very much what we're focused on, because it's those term prices that dictate what you're going to get when you're signing contracts with these utilities. And I think if the market could get a better understanding of that, they may take their eye off the concerns they have in the spot market and start to understand the market through the term price.
Yeah, it kind of seems like it's always that the people do look to the spot price as some sort of an indication, but I guess industry is more concerned with, where are these pounds coming from, and who's going to be able to supply it, and at that point, it's very much a seller's market from that perspective. So do you see? I guess you understand that. So there's no real need to rush into term contracts other than to give the market comfort. I mean, you're not going to, give away 100% of the of your no. I mean, how do you kind of
away 100%? But I think we want to be. I mean, we want to make sure we're making sensible decisions. So what I mean by that is that when we did the feasibility study back in 2022, the pricing that was assumed by most companies at that point in time was $65 per pound. That's what everybody thought the uranium price would be. And based on that, we made commentary that what we would like to do is put about half, so 50, maybe as high as 60% of our production into term contracts. Because of that price and knowing our cost structure, that made sure we covered our cash costs. And anything else we had left over, we could go into the spot market or into the short-term market to be able to drive our profits. Now, when we've been talking to our debt advisors, and certainly on the feedback they've had from banks and other commercial facilities out there, there is a certain amount of contracting that we have to do to be able to meet the needs of these debt providers. And the feedback that we have had, again, is sort of that 50% or something around there of our production going into term contracts, which fits in with what we wanted to do anyway. So that's sort of where we're focused. We want to make sure that we've got somewhere between 50 and 60% of our production into term contracts, but we recognize we don't have to contract everything now. These early contracts that we want to do that we spoke about are really to be able to demonstrate to the shareholders, to be able to demonstrate to the banks that Lotus as a company has the right relationships, that it has the capacity and the capability to be able to sign these contracts. That's what we want to do with these contracts. And as I also mentioned with the prepayment concept out there as well, that some of the utilities are prepared to offer, it is a way that we can look at financing the project. There will certainly be other contracts that we will look to sign as we get closer to starting the plant up again, and we'll start to fill in the gap as we work our way towards it. But we have no intention of putting 100% of our production into term contracts, because we know a number of our investors are invested in Lotus because they want exposure to the spot price going forward.
Right. And for you as an African play, lots of conversation going about what's happening, and lots of chat around Nisha, lots of chat around Namibia, Malawi, like, and even Botswana. I guess the slightly forgotten element in the African producer mix at the moment. Other groups have talked about keeping their options open as to whether they kind of supply into the West or they supply into the sort of Chinese market. China obviously has been all over Africa for decades now in terms of resource acquisition. For you, do you keep your options? Are you keeping your options open in terms of where the pounds go?
Our preference is Western focused, so North American and European, and we would include Japan and South Korea in that as well. That's certainly where we've put most of our efforts in at the moment. And we do that because, first of all, Malawi as a country is very Western focused in terms of it gets a lot of donor support from the World Bank, from the IMF, from USAID, UK aid, and all those types of things. So it is quite heavily reliant on the Western hemisphere, let's say, in terms of getting its funding and all that kind of stuff. And it has a very strong relationship with the West. So I do think that fits in with the profile that Malawi has. And I'd say Botswana is also relatively Western focused in terms of its approach to things. So that would fit in with that as well. To be honest, there's not a large presence in either Malawi or in Botswana at this point in time of China in the mining industry, which is maybe a bit different to other parts of Africa where they have made substantial inroads into the mining industry. That certainly hasn't happened in Malawi, and it certainly hasn't happened in Botswana either.
Okay, interesting. Just I guess some people trying to keep the competitive tension going out there, it would appear. Keith, appreciate the update. Obviously, a lot happening on the ground. Stay in touch. Let us know how you get on, okay?
Great. Thanks very much.